Good
Good morning, sir.
See, remember that in the last class we were seeing something on finding out interest rate implicit in the lease, right? Then see, there is some difficult moments here. I can't write on the screen. I'm just trying to fix that. In the meantime, let's know about the areas that we have just done so far. So we know what is an asset, who is a lessor, who is a lessee. Guaranteed residual value is nothing but when lessee is returning the goods, I mean the asset back to lessee, it should have some potential value for it. So that potential value is what we call it out as guaranteed residual value. That means in the name called returning the asset, when he's returning junk item after its lease term, then there is no use with the asset. So as far as lessor is concerned, during the economic lifetime of the asset, he might give it to many lessees. If one of the lessees, especially the first few, were to exhaust all the utility from the asset, when that is left with no potential value, he cannot lease it out, and thereby he will cause greater damage to the income prospect of the lessor. So therefore, in order to avoid such a scenario, the lessor will impose this condition of fixing up some guaranteed residual value. In case it is not achieved, he has got to pay the money. Therefore, every lessee will take into consideration this guaranteed residual value while he is returning. He will ensure that the asset possesses that guaranteed residual value. Unguaranteed residual value is nothing but the difference between the residual value and the unguaranteed residual value. Implicit interest rate in lease. What is implicit interest rate in lease? So, interest rate implicit in lease. You can put it that way also. IRIIL. So, interest rate implicit in lease, which is nothing but IRR from the viewpoint of the lessor, where we should take into consideration the cost of the asset that is financing or the fair value of the asset that is financing plus initial direct cost. These are the two outflows that you will be incurring. The inflows that you would be experiencing are the lease rental plus guaranteed residual value as well as unguaranteed residual value. Then POP, purchase option price, where it is a very important matter when lessor offers to the lessee that at the end of the term, if he offers the asset back to lessee at a much cheaper price than the expected fair value of that particular asset, even though the lessee may not be interested with such old asset, but he would exercise this and sell it to an outsider and make profit. So therefore, when purchase option price is sufficiently lower than the expected fair value at the end of the lease term, we will consider that the lessee will exercise the option and thereby categorizing the lease to be a finance lease from the viewpoint of the lessor. See, as far as the lessee is concerned, between operating lease and finance lease, they are going to deal in the same manner only. What is that? The lease payment, which is nothing but the lease rental plus guaranteed residual value from the viewpoint of the lessee, has got to be discounted, and the same will be debited to right of use of asset, and credit will be given to lease payable. And the right of use of asset will be amortized over a period of lease term, either on straight line basis or on number of units production basis. Majority cases, in majority of the cases, it will be written off over the lease term on straight line basis. How they just do that? Return of use of asset minus whatever guaranteed residual value that is indicated divided by the number of terms. So let me repeat, the amortization, if they have given you guaranteed residual value will be undiscounted guaranteed residual value, whereas right of use of asset will be a discounted figure. So this guaranteed residual value undiscounted amount has got to be deducted from right of use of asset, and the difference is going to be depreciable amount, the whole divided by 5 or 4 as the case may be. So here you have got to be very careful because one of the two item is discounted, the other one is undiscounted, but that is the way we have got to do. So you might just feel that it is inconsistent and all that. Actually, it is not so. We have done this many times in PPE because the fair value of the asset is the present value. For the purpose of charging depreciation, we deduct the salvage value, expected salvage value, which they would be realizing it after some number of years. So therefore, even there itself we have practiced. So therefore, there is nothing new in it, but we never understood in PPE that the cost is the present value of future benefits, but we take it up as money paid now to the supplier. So therefore, we take it up as cost. So therefore, you got to only understand that it is the same principle that we do in the case of PPE is carried out in this case also. So now getting back to incremental cost of borrowing for lessee. What do you mean by that? In case interest rate implicit in the lease is missing or not ascertainable in the problem that is given, then you got to take up incremental cost of borrowing for lessee for discounting purposes. So wherever you got to take up the present value factor, either take up interest rate implicit in the lease, that is the first rank. If that is not available, then you got to take up incremental cost of borrowing. Something like when your mom is preparing tea, definitely she will be putting sugar. In case sugar is not available on a particular moment, you can't run to shop. So she may use jaggery and a substitute. So likewise, interest rate implicit in the lease is the first preference that you got to use. If that is not available, then use incremental cost of borrowing. The classification of finance lease and operating lease takes a very great importance only in the books of the lessor, but not in the books of lessee. As far as lessee is concerned, both are same. So what do you mean by finance lease? Even though it is from the viewpoint of the lessor, we understand in the case of lease, the lessor transfers the right to use of asset to the lessee. What is that? The lessor transfers substantially all the risk and the reward incident to the ownership to the lessee for a consideration or series of consideration. Let me repeat. Lessor transfers the right to use of asset. Along with that, substantially all the risk and reward incident to the ownership of the asset to the lessee. Let me repeat. Lessor transfers the right to use of an asset and thereby transfers substantially all risks and reward. So this word substantially all risk and reward within inverted quotes should be very much an important phrase that you got to put it in finance lease. Other terms, whether you use it or not, is not a matter. Lessor transfers the right to use of an asset. Along with that, substantially all the risk and the reward incident to the ownership of the asset to the lessee for a consideration or for series of considerations. So it becomes very tight to understand what do you mean by substantially all the risk and the reward. What do you mean by risk and what do you mean by reward? Risk means when you are owning the asset, you got to maintain it, the maintenance expenditure, the breakdown of machine, and because of that, there is going to be a loss of production and impacting your profit. That is risk. Then, what do you mean by reward? The reward is nothing but because of the usage, you are generating income. That is the reward. So, it is nothing but the benefit and the cost. If the owner were to be there, what benefit you will be deriving and what cost that you will be incurring, that the lessee has got to incur. He is given only with the right of use of the asset. So you can't be bringing out a complaint against the lessor for any maintenance of the asset. That has got to be very much that of the lessor, very much of the lessee, because he is given with almost the ownership. He is the deemed owner. Who is the deemed owner? Lessee is the deemed owner. So that is what you just understand in the case of finance lease. So in order to know that is the finance lease, certain examples that they have given in the standards, we can see what are those. So we have just seen in that particular case where number one, automatic vesting of ownership. At the end of the useful life, at the end of the useful life, the useful life or lease term, I would just better use the term. At the end of the lease term, automatic transfer of ownership to the lessee. So this is what it is happening in the case of hire purchase. Therefore, all hire purchase transactions will be taken up as lease. Then, when purchase option price is sufficiently lower when compared to the expected fair value of the asset at the end of the term, whereby one can easily judge that lessee will definitely be exercising the option. So, where the difference between the purchase option price and the expected fair value should be sufficiently having difference. So purchase option price, when it is very much closer to fair value, there is no meaning in exercising it, and therefore nobody can judge as whether the lessee will exercise or not. Only when purchase option price is sufficiently lower, then you can judge that lessee will exercise the option. 3. Lease term is equivalent to or closer to economic life of the asset. So the next item number 4, the present value of lease payment is approximately or somewhat closer to fair value of the asset. What do you mean by lease payment? Lease payment is nothing but lease rental plus guaranteed residual value from the viewpoint of the lessor. Then item number 5, asset at the end of the lease term cannot be used by anybody other than lessee without major modification to it. So please understand, operating lease is nothing but other than finance lease. So we have taken up a few problems for analysis and for our understanding, and we have just taken up. Now we would like to continue with that, and I just don't want to miss the time, and therefore I would like to use Excel now. Now, from the viewpoint of the lessee, we have just done. So with one more example, I would like to take up for lesser. What is that? Or I will give you a nice example here. Example number 5 or so. So lease term 4 years. Lease rental 50,000. Interest rate implicit in lease. Interest rate implicit in lease, which is 11%. Guaranteed residual value. Guaranteed residual value is 25,000. Account in the books of lessee. So what is the solution that we are going to draw? So point number 1, there is no distinction between operating lease and finance lease. So lease payment consists of lease rentals and the guaranteed residual value. These shall be booked in the shall be recorded in the books at present value of LP at the inception. So item number 4, we will take up 1, 2, 3, 4. Lease rental, or I will just put cash flow or lease rental. What is that? 50,000. It is 50,000 once again. This 50,000 here, 50,000 plus 25,000 additionally. EVF found 1 divided by 1 plus.
Sir, Excel is not visible, sir.
What is that?
Excel is not visible, sir.
Is it so for others? Ganesh?
Visible for me, sir.
Huh? Visible or not visible?
Visible.
Visible, sir. ಯಾಕೋ visible ಇರುತ್ತೆ sir.
So it is a problem, network problem for him. Right now,
Okay, sir.
நீங்க வெளில போயிட்டு வாங்க. 50,000 into this. So it is 171,588. So rate of use of as an asset. So year number 1, 2, 3, and 4. Opening ROU asset. Depreciation. Closing ROU asset. This is the number. All of you closely follow. The depreciation is not divided by 4. So it is this value minus 25,000 divided by 4. How did you arrive at? Jitendra ji, is that visible
Sir.
now?
Yes, sir, visible, sir. Sorry, sir.
171,588 minus 25,000 whole divided by ROU asset is opening minus depreciation. And that is going to be the opening figure. So depreciation is the same figure. So finally, the closing ROU is equivalent to guaranteed residual value. Okay. Then what is that we are expected to do for lease payable? It is year number 1, 2, 3, and 4. Opening lease payable in finance cost at the rate of 11%. Cash flow, this is to be taken up as closing lease payable. Opening lease payable is this. Next one is finance cost. This multiplied by 11%. And the cash flow is 50,000. Then plus minus this. So this becomes opening. So here, this is going to be 50,000 only. This is the difference between the two. Then one moment. See here, there is a small difference you have. It should be 25,000. No, 3 rupees less. So therefore, I will make this as 25,000. This as 50,000. This is nothing but the sum of the next two columns where I will be deducting the opening balance. So here I made the change. So it is 50,000 plus 23,000 minus 67,565. Thereby I am just getting this as the balancing figure. Is it okay? Now the scheme of journal entries shall get operated this way. Here 0, journal entry is debit, ROU asset 171,588, credit lease payable. This is at the inception. Correct. This is the next. Year number 1. Debit depreciation 36,647, credit ROU asset. Then comes debit finance cost. This. Then credit lease payable. Then comes debit lease payable 3,000, credit bank. Then debit finance cost. Debit. I'm sorry. Debit profit and loss account. Credit finance cost and credit depreciation. So finance cost, this depreciation is this. Then equal to sum of the two. Now this is the scheme of journal entry for each of the years that we got to try. So it is year number 2, year number 3, year number 4. Just see year number 1 over. This is year number 2. Depreciation is this. Finance cost is this. Lease payable is this. Okay. So automatically it is taken care. Okay. Year number 3. Okay. Depreciation is this. finance cost is this. Lease payable is this. Then this is taken care. This is year number 4. Finance cost now all of you closely follow. See here, I am returning the asset. Debit, lease payable. I am discharging my liability. Credit, right of use of asset. Therefore, at the end of each one of those years, so I will put it like this way. My balance sheet. So it is year 0, year 1. So this is going to be 171,588. Here ROU asset. This is lease payable. Year number 1 is this. In this particular case, it is before. This is after.
இப்போ கரெக்டாக பண்ணுறோமா?
ஏன் கரெக்டாக பண்ணாம?
நம்ம லீஸ் பேபிள் வந்து ஃபினான்ஸ் காஸ்ட் படி
ஃபினான்ஸ் காஸ்ட் தான். ஃபினான்ஸ் காஸ்ட் தான். ஏன்?
இல்லை க்ளோசிங் லீஸ் பேபிள் என்னன்னு பாருங்க இயர் 1க்கு.
ஓஹோ, இதுவா?
ஆர்ஓஇ செட்டோட போட்டுருக்கேன். அதெல்லாம் சொல்றேன்.
This is balance sheet effect. So then profit and loss account. Actually, this is not correct. So it will be depreciation and finance cost. Depreciation is this. Finance cost will be this. Year number 2. Depreciation will be this. Finance cost will be Now, total impact. So I have to affect the total, this plus this plus this plus this, which is nothing but 50,000 into 4, 2 lakhs. Come on. Say copy row wise. Don't copy column wise. That is also a problem as why you are not allowing me to push the screen. Say this I have just inducted new.
இது நியூ
This lease payment is equal to sum of lease rental plus GRV. Though I have written, but in the form of equation I have written here.
సార్ కొంచెం ఆగలేదు సార్.
So in your notebook, you put 2 sides and simultaneously note down ROU asset, lease payable. So here 4 columns, there 5 columns, or 4 columns. Here can be kept common for both. Okay, but do it simultaneously. Don't write this and this even when I'm just moving. So write row wise only. Come on.
சரி கொஞ்சமா.
Row wise. Please understand row wise you
ரோ
have to
வைஸ்
copy.
சரி எழுதுறேன். ரோ
Ah?
வைஸ் தான் சரி. ரோ வைஸ் தான் காப்பி பண்றேன்.
அதுக்கு நான் பதில் சொல்ல வேண்டாம். நான் சொல்லிட்டே இருப்பேன். நன்னா படிங்கோ அப்படின்னா என்ன சொல்லணும்? நன்னா படிக்கிறேன் சார். நான் ஒரு தடவையும் சொல்ல மாட்டோம்ல.
படிக்கிறேன். சரி சார்.
அதான். So divide the page into 2 halves, journal entry and impact in balance sheet.
சார் கொஞ்சமா. சார் ஸ்க்ரால் டவுன் பண்ண முடியும். சார் ஸ்க்ரால் டவுன்.
Scroll down, appa.
டவுன் சார். சார் நாட் அட் கியூஎஸ். Noted. Sir, noted, sir.
How about others?
Noted, sir.
Right. See, now I'd like you people to take up question number 28. C. So leave this cost of the asset, okay? You are provided with 16.57% as interest rate implicit in lease. 50,000 lease rental in advance, 4 years. 30,000 as residual value and 20,000 as guaranteed residual value. They mentioned find out the amount of lease asset to be recorded at the inception of lease in the books of lessee. So it is 28C. Ignore 177,500. Rest of the matter you got to take it up and do it now. Please try, and I will also be trying out simultaneously, but I will not share the screen. I hope that all of you are having this PDF. In case you are not having it, now I am sharing that. It is all about 28C. So what do you mean by advance? The lease rental is payable at the beginning of the year. 4 years would mean the payments will start from year 0 onwards and it will end by year 3. So year number 0, 1, 2, 3. 4 payments will be taken up that way. Of course, guaranteed residual value will come only at the end of the term.
இப்போ என்ன கண்டுபிடிக்கணும் அதுல
ம்
வெறும் இந்த லீஸ் பேமெண்ட் தான் கண்டுபிடிக்கணுமா
ம்
இல்லாட்டி அந்த இதெல்லாம் பண்ணணுமா
சரி லாஸ்ட் ப்ராப்ளம் மாதிரியே எல்லாமே
ஃபுல்லாவா
ஏன் 50% விட போருமா ஏன் அப்படி கேட்குற ஒரு ப்ராக்டிஸ்க்கு தானே சோம்பப்படாத அது உனக்கு ஒரு புது ஐட்டம் கிடைக்கும் நீ பண்ணாதான் வரும் அதை நீ காப்பி அடிச்சேன்னா வராது யூ வாட் டு டூ If you have just completed, please let me know.
கடைசி டேபிள் மாத்திரம் பண்ண தெரியல.
ம்.
லீஸ் பேபிள் லீஸ்
ம்.
பேபிள் போட்டேன், பட் கடைசியில் வரமாட்டேங்குது.
வரமாட்டேன்டுதா?
Completed, sir. Working, sir, online.
So please just check up.
முடிச்சிட்டு ஒரு நிமிஷம் இல்லைன்னு சார் தப்பாக கண்டுபிடிச்சிட்டோம்.
Please just check up the computation. See, what is very important in this problem is that they given 50,000 in advance in 4 years period. So where you got to start your lease rentals from year 0 onwards. So therefore the PV factor that you got to take up for year 0 is 1. And the guaranteed residual value comes at the end of the term. So therefore it cannot be in the 3rd year, it should be in the 4th year. So as the PV factor is changing, the present value of cash flow is ROU asset 172,087. Is that right? All of you, are you getting it?
Correct.
So depreciation, of course,
Yes,
will be coming out for year number 1, 2, 3, and 4. So how this number had just come is the same way as in the last case, 172,087 minus 20,000 divided by 4. And that is a way at the end of the term, you should get 20,000. So therefore, I've adjusted 1 rupee difference into depreciation. Lease payable, where this table has got to be started from year number 0 going up to year number 4. So 5 rows you will be having. So this is the working, and this is an adjusted figure. So 20,000 minus 17, 161. So when you pass journal entry, you have to pass journal entry from year 0. This is the inception and the first installment getting paid now. So year after year, the depreciation and the finance costs that we have picked up, we have updated, and the lease payment and how much we debit to P&L account in year number 2, the same thing. So lease rental 50,000 and some of the finance costs and depreciation here. Year number 3, similarly. But in year number 4, you will not have the installment that was paid completely, and lease payable, this is written off asset in asset, that is guaranteed residual value. Am I right? So this will set your thing of understanding clearly many things from lessor's point of view. Are you clear? Say yes or no. Are you clear?
Yes.
Yes, sir.
Right. Say I would like to take up a 10
Yes,
minutes
sir.
break. 10 minutes break I would like to take up because I wanted to close this because I got to write on the screen. So I will stop recording here. And once again,